Hi, I'm Baldwin Burgess, and welcome to the first episode of the Real Assets Investing series. In this piece, we have Peter Pavlov, the portfolio manager of the Silk Sustainable Real Assets Fund. This is a strategy that provides investors with an actively managed allocation to 7 key themes that are set to benefit from an unprecedented growth in global demand, and the strategy could also help investors protect themselves against the threat of rising global inflation. In this first episode, Peter and I discussed the oil industry, which is a key component of the energy theme within the sustainable real asset strategy. And we recorded this episode on November 26, right after a strong downturn in oil prices. And during the next 8 minutes, we will explore the fundamentals that are driving this market to better understand where oil prices may be headed in the medium term. So good morning to you, Peter.
Good morning, Baldwin.
I guess a great way to start would be to hear your current thoughts on the oil industry. And as we record this, it seems like the market has made up its mind that we have wound up in a bear market after the recent drops. What do you make of all this?
Yes, technically you are correct. Oil market is in bear territory as prices have crashed by more than 30% since early October. During that 7 weeks, actually longer dated futures held a better, and this is the result of a series of factors that we could analyze. Those factors are typically located in 4 different areas. When we talk about geopolitics, positioning, technical price development, refineries, we are only exploring a very small subset of all the indicators and factors that lie behind oil prices development, but for us, those are one of the main ones. When it comes to geopolitics, when we entered September, the US administration have been given indications that sanctions on Iran will be much more severe than last time, and no waivers will be granted to any important country. At the end of October, actually, the US administration reversed course, and countries like India, China, South Korea, Japan, Turkey actually received authorization to continue to import Iranian oil, at least temporarily. Then when it comes to positioning, throughout H1 this year, asset managers have been building long positions in oil futures, and that situation came to an end at the end of H1. Then it slowly started to decline during the summer months, and then since the end of September, asset managers have cut their positions by a pace that we have not seen in the past 4 years. Net open positions declined by almost 190,000 contracts, and simultaneously we had short positions increasing at a very rapid pace. We are talking about a figure close to 70,000 contracts on a 3-month rolling basis. Technically speaking, the picture is also very complex, as oil prices didn't manage to hold above any important support levels over the past 7 weeks, and even last week on Friday, oil prices broke below the last important support that is located around 60. We're in the middle of refinery maintenance season, and this is what typically lies behind the seasonality we are seeing in oil prices. This year, the maintenance season actually caused an important increase in oil inventories throughout the US. All of a sudden, the market switched from a situation where fears of a supply crunch drove prices above 80s in September to a situation where fears of oversupply drove prices below 60 at the end of November. As we speak, oil prices are set to rebound.
So the overall narrative, sentiment, and even the consensus seems to be quite bearish for oil prices. But Peter, can you tell us a bit more about why you see value at these levels?
What is important is that actually fundamentals do not imply such a steep decline in oil prices. If we take a step back and we look at who can produce so much oil in the world to be able to meet additional demand, which is expected to run at 1.5 million barrels a day per annum over the next several years, we are looking at basically three different countries, which will be US, Saudi Arabia, and Russia. We know that Saudi Arabia and Russia, they are close to full capacity, and over the past few years, the US managed to become a major oil producer, and most of that increase was actually driven by shale oil. When we look at the hard data, that shale oil came from three major basins in the US and most importantly from the Permian. One would argue that the increase we have seen over the past years in terms of oil production, US oil production, cannot be repeated for a very simple reason, and that reason being that the Permian is actually missing takeaway capacity. That means that the oil that is being produced and extracted in the Permian cannot be shipped easily or economically viably to the Gulf Coast where it can be exported to global markets. Also, the oil that is being produced in the US is not of the same quality as the one that is being produced in the North Sea by Saudi Arabia or by Russia. What is important also to mention is that production increase in US oil production coming from shale oil, it comes with a price, and that price is that if you want to maintain same level of production, one needs to drill more, because most of the production that a well can deliver is actually front-loaded, and after 2 or 3 years, the decline is very, very steep. Hard data from Baker Hughes indicates that drilling activity never really recovered from the trough that we have seen back in 2015 during the oil market crash. And finally, we have an upcoming meeting of OPEC countries and allies in Vienna on December 6th. And during that meeting, chances of production cut are quite elevated. Saudi Arabia have already indicated that they are willing to limit their production by 500,000 barrels a day. And what is really unknown is by how much other countries will be willing to participate into that move.
Okay, Peter, let's summarize so we can leave the listeners with some key takeaways and pointers about what to expect from oil prices in the short and medium term.
Currently, oil prices are probably overshooting the negative environment for oil demand, and probably we are going to see a stabilization in oil prices in the short term. Even a small rebound could be seen. Going forward, the much more medium term, we are probably going to see increased levels of volatility, and that is going to create opportunities for nimble managers to participate into the oil market.
Thanks very much for sharing your thoughts with us, Peter.
Thank you very much.
And thank you very much for taking the time to listen to this episode. To make sure not to miss other episodes of the Real Assets Investing series, please go to silkinvest.com and subscribe to our list at the bottom of the site. That way we can keep you updated of new episodes as they come out. So thanks again for your attention, and until very soon.